Our next guest teaches entrepreneurial finance at Northwestern's Kellogg School of Management. His classes have brought in eager young business people from all over the world. Please welcome Professor Stephen Rogers.
All right, Stephen, come on out.
Welcome to the summit.
Good to see you, Stephen.
Have a seat.
Thank you very much.
Here
It's my
we are.
pleasure to be here.
Day number 3. We've learned so many things already. Hopefully everybody at home, they got out of bed, they put on a suit, they dressed for the part, they took a loop around already, they cleaned out their inbox.
That's right.
And depending on which guest they've been inspired by already, they've potentially started about 12 other companies
That's
since
right.
yesterday.
Yeah, follow your passion, right?
Yes. Today we're talking about finance, and we've got a great role model here to bestow us some wisdom, help us manage our money. What were some of your early enterprises as a young man? Help us, before you could become a teacher, you had to learn it.
Okay, absolutely, absolutely. I was real fortunate that I was raised by a single parent, and my mother was an entrepreneur herself. In fact, she was what I call a mom and pop or a lifestyle entrepreneur. She was the type of person who always liked to buy things and then resell them. So I was raised in that type of environment where there was no business plan or anything like that, but just a very ad hoc and haphazardly running a business. So as a child, I emulated that, and so I had the newspaper routes, and I had the lemonade stands, and I did those type of things that we see or have heard about children doing in the past. Today, I guess the only thing that they do is do video games. I don't know if they do those kind of things like they did in the past, but no, I was sort of indoctrinated in the entrepreneurial world by my mother.
Your mom, so she was your big inspiration. Did she ever own business, or a jewelry business, did you say?
Well, my mother owned several companies. It was a used furniture store. We used to go to flea markets to sell on a regular basis. We owned restaurants, but all, again, were mom and pop operations.
Right. So when you mean mom and pop, what's the definition of that exactly?
Yeah, a mom and pop is also known as a lifestyle entrepreneur. A lifestyle entrepreneur or mom and pop entrepreneur is a person who runs their business haphazardly. He has no business plan. He basically takes whatever the business gives him because he's just looking for the business to enable him to live a certain lifestyle, and hence the title lifestyle entrepreneur. And we contrast that to what I teach. I teach high-growth entrepreneurship, and I'm hoping that that's what your audience is interested in, and that is high-growth entrepreneurship. And a high-growth entrepreneur, in contrast, is a person who has a business plan. She writes and works the business plan on a regular basis. She also expects the business to grow as a result of working that business, to grow exponentially, with the byproduct of that growth to be wealth creation. Ideally, wealth creation not only for the investors and also the entrepreneurs, but possibly even wealth creation for some of the employees. Bill Gates with Microsoft produced 6,000 millionaires as a result of his high-growth entrepreneurial effort.
Right. Well, speaking of teaching, that's your day-to-day. What do you want students who come into your class in a perfect world to walk away with? What knowledge do you want them to really walk away with?
I think that's a great question, Chris. What we really want them to walk away with is the fact that, and the knowledge that passion and motivation and energy is not enough. That it's imperative that people learn the fundamentals of finance that will ultimately lead to, ideally, wealth creation for themselves. And therefore, it's imperative that they learn how to apply fundamental tools of finance, fundamental tools of marketing, human resources. But there are really things that you need to learn in order to grow your company such that you're not stuck in this mom and pop kind of entrepreneurial venture. Therefore, what we really have a theme for in my class, value creation. Valuation, what's the value of your company? What's the value today? What's the value ideally 5 years from now when you've grown and ideally that value has created 5 times what it is today?
There are certain kinds of entrepreneurs that you refer to as your heroes and sheroes. Will you explain what that is?
Well, in general, entrepreneurs to me, as I give speeches around the country, I talk about entrepreneurs being job creators. And entrepreneurs are my heroes and sheroes because entrepreneurs create jobs. And people who have jobs are self-sufficient, and self-sufficient people live in healthy communities. So they're my heroes and sheroes because they help take care of other people. And the old adage that entrepreneurs do good for society by doing well for themselves, therefore applies. But yeah, these are my heroes and sheroes because they give back to society.
So you actually talk about that, Fortune 500 companies, of course, that seems like a very glamorous thing, but really you have sort of a flip-flop philosophy on that they're not necessarily the goal. Entrepreneurs are the ones who we should
Absolutely.
hold to the highest.
First of all, God bless the entrepreneurial world, because the reality is, in the world that we live in today, job creation does not come from the Fortune 500 companies anymore. Job creation comes from entrepreneurial firms. And the reality, quite frankly, is this economic malaise that we're in right now, one can probably look forward to 5 years from now and look back after that and say, we were able to get out of this economic malaise primarily because of entrepreneurial efforts. Entrepreneurs doing things to create jobs for other people such that they could have more money to put back into the market. Because what do we see? We see the Fortune 500 companies laying people off, downsizing. But entrepreneurs create jobs.
By the way, we are live. We should remind folks so they can email or call in questions or instant message us if you want. You have a question for Stephen. Now, Stephen, I know that acquisition is a big part of what you're teaching. Why is that so important? That sounds like, for a small business owner, that sounds like, wow, acquisition. How do I do that? Great question.
Let me just say this. Again, we go back to Chris's question earlier around what is sort of a common theme of the classes that I teach. I teach about value creation. And in order to create value for oneself, one must grow their company. And therefore, one of the means to which you can grow is through acquisitions. Basically, there's two ways to grow. You can grow organically, or you can grow via acquisition. And growing organically is really a challenge. And so what I like to try to make entrepreneurs aware of the fact is you can also grow via acquisition. You can emulate, if you will, again, Bill Gates and Microsoft over the last 5 years or so. I think they've spent in excess of $10 billion acquiring other companies. The same can be done with entrepreneurial firms, and that is look to buy other companies for the purpose of growing your firm. And as a result of that, again, you can get into that high growth entrepreneurial category because you're looking to grow exponentially, with the byproduct of that growth being wealth creation.
Let's talk about like the practical breakdown of acquisition. What can somebody expect or be willing to put down in advance, and what kind of thing can you expect to see in return?
Great. Let me just first of all say, acquisition also is a way to go the entrepreneur route. And so in terms of becoming an entrepreneur, one can become an entrepreneur by starting something up from nothing, going the franchise route, or acquiring a company. We've also talked about acquisition as a means to grow a company. If you're looking to buy a company for the purpose of growing, you should expect that that's going to probably be something that's probably going to take you a year or so to consummate. In all likelihood, an acquisition will require you to put down 10 to 20% of the acquisition price, and then you go out to a bank and get the balance via a loan, ideally. And in essence, it's very similar to buying a house. Doesn't it sound pretty similar? And that is, you buy a house, you put down 10 to 20%, especially in the new market that we have today. In the past, you could get something for nothing down, but today you go 10 to 20%, and then you get to a bank to finance the balance of it via a loan. And the key to an acquisition and getting bank financing is to ensure that the projected cash flow that this business will be able to service the debt in 5 to 7 years. That's a key right there.
That's the formula.
That the cash flow under the worst case scenario, not the cash flow under the best case scenario, the projected cash flow under the worst case scenario should be able to finance the loan in 5 to 7 years. Why the 5 to 7 years? That's the typical amount of time that a commercial lender gives you. They amortize a loan over 5 to 7 years. So it has to be paid for by that period of time.
Is this a good time to acquire things because interest rates are low?
This is a great time to acquire things. That's an outstanding question. Interest rates are low, so the cost of capital is very low. The other thing is, during these tough times, this is a great time to grow your company. You know, Business Week magazine started 6 weeks after the onset of the Great Depression. And the reality is, during these tough times, these are great times to buy and grow your company, because what we'll see, for example, 3 to 5 years from now, we'll see a lot of companies prospering. And when you ask them, what was the key to your success? They'll say, during the tough economic times, I hunkered down, I applied some great disciplines in terms of keeping my costs under control, such that when things turned around, I continued to keep my costs under control, and therefore I've had this great cash flow as a result of it. So it's a great time in terms of the cost of capital being low. It's a great time, quite frankly, also because a lot of people are looking for exits. How do I get out?
They're scared.
You hit it right on the head. They're afraid. And again, we can make the analogy with the housing market. This is a great time to buy real estate if you have the funds or the proceeds to do so.
But it's scary because you don't know where it's going.
Absolutely. That's the beauty of entrepreneurship. If you want a safe haven, then take that job. And that's kind of scary also because you don't know if you're going to be employed very long. So it is scary. But you know what? If we look at the traits of the high growth entrepreneur, one of the things you'll see is that these are people who like to take risks.
They're
Taking risks,
pavers.
yeah,
You gotta lead
absolutely.
the way.
Some people view taking risk as being scary. Other people view taking risk as being very self-fulfilling and exciting.
Right, and these are people who aren't afraid to lose it all either.
They're not afraid to lose it all, but ideally, let me try to refute the whole notion that entrepreneurship requires blind risk taking. No, again, let's go back to the high growth entrepreneur, and that is the person who has a business plan, who works their business plan. It's calculated risk taking. And yes, absolutely, even with calculated risk taking, you can lose it all. But that should not be an all or nothing mentality.
We've got an instant message that they just handed me here, and it says, and this is open-ended, so you answer. Have you identified any new businesses that are likely to develop based on current trends and future needs over the next few years?
You know, that's one of the areas that I'm not very good at, and that is forecasting any particular industry or anything. I just like to tell people, focus and look for businesses that you're interested in that have good fundamentals. An industry that has good fundamentals. What do I mean by that? The industry is growing, at least, in my opinion, twice as fast as the economy is, okay? At least twice as fast, if you will, excuse me, as inflation. Inflation now 2.5%. I don't believe that you should be looking at a business to buy or go into that is not growing, that industry is not growing at least at the rate of 5% a year. Secondly, make sure that you're going into an industry where there are companies that are profitable.
Right.
There's nothing worse than to go into an industry, okay, like the hardware industry, for example, with technology. You can't make any money off of hardware for the most part, okay? Very low margin industry, and therefore I tell people, go and look for industries where there's money being made, not just revenues being generated, but bottom lines being generated.
This might sound like a really stupid question, but when you're looking for an acquisition, does it have to be related to what you already have?
Oh, what a great question. What an outstanding question.
All right,
Absolutely.
good.
You know, one of the
Not
things...
scripted.
No, it's not scripted
only
at all.
unscripted.
It's completely ad-libbed here. But what I try to impress upon people, be it entrepreneurs as well as I do the same when I go to talk to Fortune 500 companies about this concept called entrepreneurship, and that is entrepreneurship in a big corporate setting, and that is don't limit yourself by your industry. Think much broader. Allow yourself to be free to think about what else could come under your umbrella. A lot of people tend to think of themselves as strictly, I am a technologist, I am a restaurateur, when in actuality, what you may be is a marketer. And if you're a marketer, therefore, you can market different products out of different industries. And so your umbrella should be very broad. And so it's a great question, and that is, don't just limit yourself and think very broadly about what your skills are, not simply what your industry is. And therefore, if you say, listen, my greatest skill is pulling together customers and selling products to them. I am presently in the industry, my business was the lampshade industry. I acquired a lampshade company. I'm not a lampshade manufacturer, but I'm a salesman. So my whole thought was, I can sell other products. So why not have several companies that's in the business of selling?
Very good. We'll take a pause and we'll be back. Talk about the importance of increasing the value of your company. Hang tight.
Right.
Thanks for watching the world's largest small business summit on your personal computer. It's the world's largest, ironically, in a media player that fits right there on your computer. Beauty. Good stuff right here, as you've probably already seen. Great offers. You want to contact us, we're going to put that information right below us. Piece of cake. And here we are live, webcasting around the world from Studio B on the Microsoft campus near beautiful downtown Redmond, Washington, outside of Seattle, if that helps you place us. All right. We're with entrepreneurial professor Stephen Rogers, and as we now learn about increasing the value of our small businesses, and we want to talk about something that you already sort of touched on. You talk about valuing your company annually. What is that? The importance of it?
Yeah, first of all, let me just say that I've always been astounded by the fact that most entrepreneurs have never valued the company. I teach entrepreneurs throughout the world, and I'll oftentimes take a survey, how many of you have ever valued your company? And typically, maybe 5 to 10% of them have.
What does that
That's
mean
a great
exactly?
mistake.
What
What does it
value?
mean?
Yeah.
Great question. Valuing means what is the price of your company? What is, if you were to sell your company today, what could you get for your company? So that's when we talk about value, then that's what we're talking about. And therefore, I believe it's imperative because this whole thing called entrepreneurship is about creating value. For the most part, people are in it with the expectation that they will enable them, it will enable them to pay their bills in the short term, and ideally enable them to create some wealth that they can transfer ideally to future generations. So it's imperative that people value their company at least once a year. And what do I mean by that? What's the price of your company? Okay? And the worst thing that people can do is ignore that and then raise their head up from working hard for over 20 years, which is what one entrepreneur did and that we worked with at Kellogg. He came to us after 20 years of ownership and said, I'd like to sell my company. What's the price? What can I get for this company? We valued the company, and we told him, you can get probably $200,000 to $250,000. He was devastated. He said, I wanted to walk away with about $1 million. We said, you never valued your company, so you never had any sense of what you were doing in terms of, were you creating value simply because you were increasing revenues? Or where's the real value creation area in your company? Is it revenue generation, or is it at the bottom line with cash flow, EBITDA? Okay.
So how do you go about measuring your value? I mean, it's like, okay, 2 office chairs, 1 desk, you know, a couple pads of paper.
Great question. There are a myriad and sundry ways to value a company. I would estimate that there are probably at least 10 different ways to value a company. You just cited ones that would be called probably an asset valuation, which is commonly used. What's the value of the assets? That kind of valuation is commonly used when one is looking to buy a company that's in a turnaround, an underperforming company. You get the depreciated asset value of the company. But the 2 most popular ways that I would like to mention today would be the multiple of revenue valuation model, and then secondly, the multiple of cash flow valuation model. Multiple of revenue model, what's the sales, what's the revenue of your company, okay? Then times some number. That multiple, okay, in the world of business, the range of multiples that one should expect in terms of multiple of revenue should be anywhere from 1 to 2 times revenue, okay? So if you're a buyer of a company, you should expect, if you're going to use this valuation model, a multiple of revenue, you should not look to pay any more than 2 times the revenue. So if it's a company you're looking at, it has $5 million of revenue, at the absolute most, you should be paying $10 million for that company. Now, there's another valuation model, and that is called the multiple of cash flow, the multiple of EBITDA, and EBITDA, earnings before interest, taxes, depreciation, and amortization. And everybody in this audience can get it, because I was watching The Sopranos one time, and Paulie on The Sopranos literally said the phrase EBITDA when I sat there and almost fell off my couch when he said it. So if he can get it, everybody else can get it. But EBITDA is a synonym for cash flow. And therefore, a multiple of EBITDA should be used. And the multiple that's commonly used, and it varies by industry, but I am personally a 4 to 6 man. The value of a company is 4 to 6 times EBITDA. Now, if you go with that kind of expectation of valuing a company no more than 6 times EBITDA, if you get 80% of the company financed with debt financing, and the cash flow never improves to anything better than what it is today, you should be able to pay that debt off in 5 to 7 years. You see where I'm going here? And that is, remember in the previous segment I talked about an amortization, a debt amortization 5 to 7 years, that the value of the company, Penny, should be directly related to its cash flow, because its cash flow will be used to service the debt of the company. So every entrepreneur should value. It's starting to make sense. Listen, I always tell people, there you go, exactly. This is not brain surgery. And anyone who tries to make you believe that this is brain surgery in terms of being overly complicated, they're doing it for one of 2 reasons. One is they're intentionally trying to confuse you because they're trying to take advantage of you. Or 2 is they don't know what the heck they're doing. Okay? So I believe in the KISS formula. Keep it simple. And all entrepreneurs should be empowered with the fact that they can understand valuation for the purposes of buying other companies, valuation for the purpose of selling their company, valuation for the purpose of raising capital, that valuation should be a part of every entrepreneur's toolbox.
And you abbreviated the KISS label, because
Yes,
I've
I
always
did.
heard it as
Yes.
keep it simple, stupid.
Well, you hit it right on the head. Yes, I did. As soon as the family
Professor,
audience.
you've intrigued one of our viewers. Jen in Delaware is on the phone. Jen, question for the professor.
Yes. Hi, Dr. Rogers. How are you today?
He's
Hello?
doing good. I'm not sure. Can you hear her?
No.
Okay, we'll translate. What is your question?
My question is this. When you go to a bank, how do they determine the value of the business you're about to acquire? My husband and I, years ago, had an idea. We went to a banker, and basically they just couldn't see the value in it at all. Well, we turned around and did it anyhow, and it made money. But my point is, where are these bankers coming from? How do they determine? Like, you have an idea, you want to buy something, and you see the value, but they don't. I mean, how do bankers value your business?
What a beautiful question. First of all, they'll use one of the models that we've discussed, and ideally what they'll use is the model that renders the lowest valuation, and therefore they give you the lowest amount of money, reducing the risk that they're taking on. But most importantly, you need to know, and that's what a great question. You need to know that the banker, in terms of if you were going to do an acquisition, a banker is looking for that business's cash flow to be such that the cash flow ratio to debt obligation being the principal and interest, the cash flow ratio to debt obligation should be 1.25 to 1. That you should be able to generate $1.25 for every dollar of debt that you have. Now, what we see, things have changed now with the market, with the economy changing. Now they're looking for a debt to cash flow, a cash flow to debt ratio of 1.5 to 1. So be mindful of that. When you come in to talk to a banker, that your pro formas, okay, under the worst case scenario, we should always do 3 scenarios, okay? A best case scenario, worst case scenario, and likely scenario. They'll probably make their decisions off of the worst case scenario. Under the worst case scenario, that your cash flow can service that debt that you're taking on to the tune of 1.5 to 1 ratio, okay? That's on the annualized cash flow basis. You have that amount of cash flow available to service the debt. And therefore, that debt has to be serviced in 5 to 7 years. So be aware of the banker in terms of valuing the company. If they value the company and you're doing an acquisition, if you overvalue the company you're going to buy, showing that the cash flow can't service the debt, then you're prime and a prime candidate to be rejected.
All right, we have this instant message just in. Dr. Rogers is providing some great insights. Being in the computer business, I agree there is no money in hardware, and most of our revenue comes from service-ended business. However, it seems that the only way to make real money is to have a product. How do you feel about this?
Well, I agree that it's important to have a product, but be mindful that a product can be an intangible product, and that can be your brand, yourself. Clearly, Microsoft has products, but Microsoft also has a brand. I don't believe that businesses are just restricted to tangible products. We have some great companies out there that have been, and I come from one of the industries, the consulting industry. I worked with Bain Consulting Firm, and they have a great brand that they sell, and they get paid a huge amount of money by their customers for applying that brand to the company's needs in terms of consulting needs. So I don't know if one needs a tangible product to have success. It can come from service industries as well. And service industries get great valuations, and so one should not feel like they're limited to just to tangible product companies.
Now, you've got a book, and we've actually got it right here. Do the modeling, Penny.
Yes, I will.
What kind of things are we going to learn in your book? Because obviously, a lot of this, to the average small business folks, especially the people just starting, are probably very overwhelmed with all of this. A lot of numbers, a lot of math. What kind of things can we walk away with from your book?
Let me just say this. That book is chock full of great data, and it's written in an everyday man's language. It is written ideally such that any entrepreneur can understand it. It is not written...
The KISS formula.
You hit it
keep
right
it
on
simple,
the head.
stupid.
To keep it simple. I'm a former entrepreneur. I love entrepreneurs because, as I told you earlier, they're my heroes and sheroes, so I want to do any and everything to help entrepreneurs grow. That book contains information about how to value your company. It shows all of the valuation models with all of the different formulas that one can use, with anecdotes and examples in it. It shows, and that book also has in it a business plan format. Everybody out there should write a business plan if you haven't written one before. It's a great guideline to show you where your company is going. So the business also has in it sources of capital for entrepreneurs, be it debt capital or even equity capital for entrepreneurs. So it's chock full of information that I believe will help entrepreneurs at every level of the spectrum grow their companies by taking this information and putting it in their toolbox.
All right, we have another instant message here for you. It says, I'm sitting here with a fictitious business name form in my hand, ready to start my own business. What should my steps to success be? And keep in mind, I have very little funding, if any at all.
Yeah, first of all, first of all, as I stated before, everybody should write a business plan. Passion is not enough. Energy is not enough. a business plan should be written for
That's
the
your
purpose
blueprint.
of. That's your blueprint. That's if you're going to take a trip, you're going to go and pull out the map to find out what road are you going to take when you're driving on that trip. It's your blueprint. So everybody should write a business plan first and foremost. It can be a tough thing because some people say it slows me down. I just want to get into the business.
Right.
Yeah, I'm a doer.
But, I'm a doer.
I just want to make the jewelry.
Exactly. But listen, I love to play golf. And I never created a business plan, if you will, of any kind in terms of how to learn how to play golf. That's why I can't play worth a doggone now after 5 years of playing. I should have taken lessons and I should have learned the proper way. And that's one of the things that we're really trying to focus on, and that is stop on-the-job training, ladies and gentlemen, and prepare yourself in the proper way such that you increase your chances for entrepreneurial success. Listen, Chris and Penny, most entrepreneurs fail. Literally, the statistics will show
Sand traps.
7 of them will, for the most part, fail. You hit it right on the head. And why do they fail? Research shows that most entrepreneurs say that they fail because of lack of training, too much on-the-job training. So that book will help you formalize your training process and increase your chances for entrepreneurial success.
All right, the book is called The Entrepreneur's Guide to Finance and Business by Dr. Stephen Rogers. Thank you so much.
Thank you
very
very
enlightening.
much. It was my pleasure. Thank you.
More info, log on to sbsummit.com/guests. Got some reading to do.
Yeah, we sure do.
Thank you so much.
Thank you. It was my pleasure.
Yeah,
Thank you.
wonderful.